The last 10 days have been very interesting when it comes to economic news because first we got news saying that our economy is growing slower than we originally thought, and what we originally thought was already slow. Then we got news saying that inflation is still hot, and most recently we just got news saying that the job market is hotter than expected, even though unemployment rose to 4%, and this hotter than expected job market caused stock prices to fall. So what I want to do today is kind of sum up what's going on in the economy right now because there's been a lot of interesting things happening, especially as we get closer to an election. So let's break it all down. And the reason why I have a different scenery around me right now is because I'm actually in San Diego doing a couple podcasts out here before I head back to Detroit. So let's start by talking about the economy. The first piece of news that we got about a month ago is that the first quarter of 2024, our economy grew by 1.6% annualized. And that was already significantly slower than what was expected. Well, what we just found out about 10 days ago is that that number was wrong. The economy actually grew by 1.3%, not the 1.6% that we originally got. Now, the reason why this is important to understand is because the reason why the economy grew by slower than expectations was because of the effects of inflation. Now, remember, what causes the economy to grow? Spending. The more money you spend, the more money somebody else makes. If you walk into Chipotle or Sweetgreen and you spend money, these companies make money and that grows the economy. If you walk in and you don't have money for the extra guac, well, then they don't make money. And what we're finally starting to see, this is the first time we're seeing this now in 2024, is that the effects of inflation are starting to catch up and change consumer spending decisions. Now you might say, well, inflation has been around a long time, Jaspreet. What do you mean it's just starting to affect people? Well, up until now, people continued spending despite inflation. And what I mean by that is, although there was inflation, although wages did not rise fast enough to keep up with, inflation rose faster than wages, what ended up happening for a lot of people is people will continue spending with credit cards, lines of credit, buy now, pay later, digging into their home equity or digging into their savings or retirement accounts. Now what we're starting to see happen is a little bit different, where people are starting to spend a little bit less. Now, have we seen a drastic shift? No, not yet, but we're starting to see that first shift, and we'll see where it continues from here, whether it continues down the same route or if people suddenly find more money. So that's the first part on the economy, which is that people are slowing down spending because of the high inflation. The second thing has to do with the job market, because just late last week, we got new data saying that the job market is booming while unemployment rose slightly to 4%. Let me actually read you the title of a Yahoo Finance article, what was on the homepage. It said, "Stocks dip after job report smashes expectations." Now, this is interesting. We got a great jobs report, which caused the stock market to fall. And you might wonder, why is that happening? Because the stock market is supposed to be a reflection of the economy, right? If the jobs market is strong, that means people have jobs, the economy is good, market should go up, right? Well, not necessarily. And the reason why has to do with interest rates and the Federal Reserve Bank. So now remember, the Federal Reserve Bank is the central bank of the United States. They're not federal, they're not a reserve, they're not a bank, it says so on their website. But what they have the ability to do is cut or raise interest rates. So if you go to buy a home today, you know the mortgage rates are a lot higher than what they were a few years ago. If you go to finance a car, mortgage or car loan rates are a lot higher than what they were a few years ago. Well, the Federal Reserve Bank has the ability to raise or lower interest rates. They don't change your mortgage rate directly. They change the rate that banks charge each other. It's called the federal funds rate. This is the wholesale baseline rate that banks get when it comes to borrowing money. Now, the Federal Reserve Bank has been talking about potentially cutting interest rates since 2023, but we haven't seen it happen yet. And the factors that the Federal Reserve Bank is looking at when it comes to raising or cutting interest rates are number one, inflation, and number two, the strength of the economy. And you have a lot of people that are putting their money into the markets hoping that the Federal Reserve Bank is going to start cutting interest rates sooner than expected, or let's just say soon. Well, in order for the Federal Reserve Bank to cut interest rates, they need to see, number one, inflation falling, and number two, they need to see maybe some pain in the economy. If they see the economy overheating, they're not going to want to start cutting interest rates, because cutting interest rates is a way to stimulate the economy. And if you already have a very hot economy, you don't need to cut interest rates. So when you see these jobs numbers come in very hot, that gives us indication that the economy is still strong. And if the economy is still very strong, then maybe we don't need to cut interest rates. Or maybe we don't need to cut interest rates as fast as we originally thought. And that's what caused the stock market to fall, is because you have a lot of traders, you have a lot of institutions on Wall Street that are hoping and praying and begging the Federal Reserve Bank to start cutting interest rates to stimulate the economy even more. Because if you cut interest rates, more people are going to buy cars, more people are going to buy homes, more people are going to rack up their credit card debt, which grows the economy, not good for inflation, but grows the economy, which could benefit some of these companies. But this is where we're getting all this contradicting data, because on one hand, inflation still isn't coming down to where the Federal Reserve Bank wants. Remember, the Federal Reserve Bank wants 2% inflation. We're still quite a bit away from that. And in addition to that, when you get these hot jobs numbers, well, that makes it a little bit more difficult for the Federal Reserve Bank to then go out and actually cut interest rates. Which brings me to the next point that I want to talk about, which is this concept of the big stay. Now, we talked about this in Market Briefs. For those of you who don't know, Market Briefs is our free financial newsletter at Briefs Media, where every day my team is working to break down what's happening in things like the economy, the housing market, the stock market, crypto, and the global economy into a fun, witty, and easy to read newsletter. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I got the link for you down in the description below. But the big stay is the new term in the housing market. I don't know who creates these terms, but it feels like every 6 months there's a new term out there. Because originally it was the Great Resignation. Then it became quiet quitting. Great Resignation was everybody was quitting jobs, trying to find a better paying job. Then quiet quitting was, well, I don't really like this job that I have, or I don't want to follow or abide by these lifestyle changes my company's making, so I'm just going to do the bare minimum to get by. Now, the big stay is a different flip, which is people are now trying to stay in their jobs. They don't want to change. They want to make sure they stay there and hopefully get promoted. Now, that's a pretty drastic shift from a few years ago, or even a couple years ago now, when it was the Great Resignation. And everybody was looking to quit their jobs. Everybody was looking for a new career. Everybody was looking for a new job because every company needed a new employee. Everybody was hiring, and when companies were fighting for the employees, they were paying higher benefits, higher starting salaries, higher anything you wanted because they needed employees. Now the job market is flipping. And what I mean by that is employers are pushing more for productivity rather than just growth of employees. Back in 2022, companies had free money. We were still in the low interest rate era. We were still having the stimulus money, and people were spending money like crazy. So corporations were doing anything they can to hire people to just try to fulfill the demand for their products. Now that COVID money is essentially gone, interest rates are a lot higher, the free money is no longer there, and corporations are now pushing for productivity. That means now they want good employees. They don't want just employees. They want good employees. And if you're not a good employee, well, they might be letting you go. That's why we've been seeing a lot of layoffs and a lot of companies pushing for more productivity. We've been seeing a lot of pushes for the return to office. We've been seeing a lot of changes in the way that companies are hiring and who they're hiring. It's been a much more competitive job market. And because of that, now you're starting to see a shift on the employee side, which is now through things like the big stay. Now, I'll just read you a definition of the big stay so you can kind of get a better idea of what this is. This is from ADP, the payroll company. Workers who change jobs are no longer being rewarded with pay gains, says the ADP Research Institute. What that means is more and more people are realizing that maybe I won't be able to get that same big jump in pay if I leave and go to another company. And I might not be able to get that same job or the same lifestyle that I have now. And the reason why is because, number one, well, we see the shift in productivity that employers are pushing for more productivity. But number two is wage growth has also been falling. We still have high inflation. Inflation has not gone away. Inflation is still an issue. The economy is slowing, and now we're also starting to see wage growth falling. And now this is something, again, why do I say this? Why do I want you to pay attention to this? Well, number one, as an investor, is I want you to, number one, be prepared. Number two, be financially educated. And number three, understand the trends. That's how you build wealth, period. I did a podcast yesterday where I was talking about this, where the host was essentially asking, are we going to see a recession? When is a recession going to happen? And what I said was, look, we're going to have a recession. It's a fact. I just don't know when. Nobody knows when. We've seen a recession every decade for the last century. The problem that happens every single time we see an economic downturn is, well, you might see these investment opportunities arise. When the 2020 pandemic hit, crypto prices crashed, stock prices crashed, and some people who were, number one, financially educated and prepared and understood the trends were able to come in and buy. But then you had a lot of people that said, I have no money. How am I supposed to eat? Well, if you're in that situation, you are not going to be able to buy an investment. It's the same thing when 2008 happened. There were great investment opportunities, great stock market opportunities, great real estate opportunities. The problem was either, number one, people were not prepared, they were not financially educated, or they didn't understand the trends. What does that mean? You might have said, this is a great time to buy real estate. I just have no money. I lost my job. This is what being prepared is all about. And that's where most people want to get prepared when the bad thing happens. But the people that build wealth don't start preparing when the bad event happens. They know bad events happen. We have seen this happen every decade for the last century. It is not in your best interest to predict when it's going to happen, but rather it is better for you to, number one, be prepared. That means have money to protect you in case something bad happens, but also have money to be able to capitalize on opportunities and invest your money when you see an opportunity. Number two, being financially educated means understanding how do you find good investments. And then number three means being prepared, understanding the trends, which means understanding where markets are going, understanding which industries to invest in, understanding where to invest your money. That's what the trends are all about. And this is where my goal is not for you to get caught up in the emotions of the news, because that does not do you any good. In fact, that actually counteracts the good. Because when you're trying to keep up with the news, you get emotional, you buy because the media loves selling hype, you sell because the media loves selling fear, but that doesn't do you any good. You want to understand the trends and you want to be prepared, and then you want to have the financial education. That way you can capitalize on opportunities when they're coming away. And this is where my goal with videos like this is to help you to understand that there are changes happening in the economy. There always are. I don't want you to be blindsided by them, but I also don't want you to freak out because of them. I want you to understand them. That way you can use it as reason to continue building your financial education, to continue building your financial preparedness, and to continue building your knowledge of trends in the markets. That way you can find the next opportunity and use it as an opportunity to build your wealth.